Transfer pricing documentation, particularly the local file, is a cornerstone of demonstrating compliance with international and domestic transfer pricing regulations. However, while a local file might look well prepared at first glance, underlying weaknesses can invite scrutiny from tax authorities. Issues such as insufficient analysis, inconsistencies, or inadequate documentation can undermine the credibility of the file and lead to costly disputes or adjustments. The OECD Handbook on Transfer Pricing Risk Assessment, 2013, provides useful guidance for identifying transfer pricing risks, but many potential pitfalls extend beyond these recommendations. Tax authorities are increasingly sophisticated in their reviews, and taxpayers must prepare documentation that can withstand this heightened scrutiny. Below, we address some of the most common weaknesses found in local files and how to resolve them effectively. One frequent issue is surface-level analysis. Local files that fail to deeply explore the specific dynamics of the taxpayer's business and its intercompany transactions risk being viewed as low-quality submissions. Generic descriptions and boilerplate language suggest a lack of understanding or effort, which can raise red flags. Instead, a strong local file should provide detailed insights into the company's operations, market environment, and economic drivers that shape its intercompany pricing. Another critical gap is the omission of internal transactions analysis. Tax authorities often prefer internal comparables due to their high reliability, and ignoring these transactions without explanation can be problematic. Even if internal comparables are ultimately excluded, taxpayers should analyze them thoroughly and provide well-documented reasons for relying on external benchmarks. The transactional net margin method, TNMM, is a commonly used method in transfer pricing analyses, but defaulting to it without justification weakens the local file. Tax authorities expect to see an explanation of why TNMM is the most appropriate method for the transactions under review. This includes a discussion of alternative methods, such as the comparable uncontrolled price (QP) method, cost-plus method, or resale price method, and why these were deemed less suitable. Testing the profitability of an entire entity for multiple transaction types is another area of concern. When distinct transactions are bundled together without justification, it becomes difficult to demonstrate that profits are allocated appropriately. Each significant transaction should be analyzed separately, with clear documentation supporting the allocation of profits and consistency with the functional analysis. Misalignments between functional analysis and entity characterization are another common issue. For example, characterizing an entity as a limited risk distributor while describing substantial marketing and development functions creates inconsistencies that can undermine the overall analysis. The functional analysis should be coherent and support the roles, assets, and risks described for the entity. Inconsistencies between the local file and the master file can also lead to disputes. Tax authorities often compare these documents for discrepancies in descriptions of the value chain, entity roles, and financial data. Any misalignment can raise questions about the reliability of the documentation. Ensuring that the local file is consistent with the master file, while accounting for jurisdiction-specific requirements, is essential to avoid such challenges. Another common issue is the lack of financial data reconciliation. Tax authorities expect that tested margins in the local file can be traced directly to statutory financial statements. Missing or incomplete reconciliations may indicate calculation errors or a lack of transparency. It is critical to reconcile the tested margins with financial accounts, and explain any adjustments or allocations made during the analysis. Profit level indicators, PLIs, are central to transfer pricing analyses, but unsupported PLI calculations are a frequent weakness in local files. Taxpayers must provide detailed breakdowns of their calculations, referencing specific items from the financial statements. This level of transparency enhances the credibility of the documentation and demonstrates that the analysis is based on robust financial data. Finally, local files often fall short by overlooking jurisdiction-specific requirements. Transfer pricing rules vary significantly across countries, including thresholds for documentation, filing deadlines, and specific content requirements. Failure to account for these local rules can result in non-compliance and potential penalties. To address this, taxpayers should tailor their local files to meet the unique demands of each jurisdiction while maintaining consistency with OECD guidelines. Tax authorities are using increasingly sophisticated tools and methodologies to identify risks in transfer pricing documentation. By addressing these common weaknesses proactively, businesses can strengthen the credibility of their local files and reduce the likelihood of audits or adjustments. Regular critical reviews of documentation, investment in high-quality analyses, and collaboration with transfer pricing experts are essential steps to ensure compliance. A robust local file is not only a regulatory requirement, but also a vital tool in demonstrating the arm's-length nature of intercompany transactions. Ensuring its accuracy and reliability is an investment in reducing risk and maintaining operational focus.